If you have an investment-linked policy, ILP, stop what you're doing. You've been sold a convenience that is silently destroying your financial future. I know the feeling. I fell for the trap too. You were promised protection and growth in one easy package. But here's the harsh reality, that one package is the most expensive way to get either one. Look at this chart. The reason your policy value is barely growing or even shrinking is because of 3 hidden fees, especially the one that explodes when you get older. But it's not too late to fix this. The simple, more profitable solution used by every serious financial planner is to split these 2 jobs. I call it the buy term and invest the difference mandate. In this video, I'm going to show you exactly how to get better insurance for cheap and where to invest the money you save to grow your wealth without the fee trap. Let's fix this right now. If you own an investment-linked policy, or ILP, I need you to stop what you are doing and listen. This is about your money, your family, and your future. What I am about to say may feel harsh, and it might make you uncomfortable. But I have to tell you the truth. You were sold a promise. A very appealing one that one single product could solve 2 big problems. It would provide life insurance to protect your loved ones, and it would also grow your money like an investment. You could make one payment and get both benefits. That idea is incredibly tempting. It sounds so easy, so efficient, and it feels safe. The salesperson presented it as the smart, modern way to handle your finances, with glossy charts and a vision of a comfortable retirement and a legacy for your children. They sold you the convenience of a 2-in-1 deal, suggesting that separating insurance and investments is old-fashioned or overly complicated. But for a vast number of people, the reality is very different from that initial promise. The truth is, these policies are often a terrible deal. Mixing insurance and investing creates a perfect environment for hidden costs to thrive, like termites silently eating your foundation. Over years, they drag on returns. Many people discover after a decade that their cash value has barely grown or even gone down. There are 3 main fees you must know about. First and most significant, the management fee. They take a percentage every single year, win or lose, directly from your fund's returns. Even 1 or 2% per year has a massive impact. Over decades, those small percentages can shave off tens or hundreds of thousands. Second, policy charges, administration fees, platform fees, rider charges. They're taken from your premium before any money is invested, shrinking your base on day one. If you pay $500 a month, part is skimmed off the top. Momentum suffers. Finally, the age-based risk charge, the mortality charge. It rises as you age. Low when you're young, but in your 40s, 50s, and 60s, the cost climbs sharply. Your policy deducts more from cash value to cover insurance, right when you're nearing retirement. In later years, this charge can skyrocket, actively destroying your cash value. The paperwork is thick, dense, full of tables, fine print, and jargon, designed to look official and complex. Sales is engineered to emphasize benefits and downplay costs. The long-term damage stays buried. When you mix insurance and investments, hidden costs thrive. For many, it's a bad deal. Over time, fees act like a permanent headwind on your wealth. At first, charges seem manageable. You're told they're just standard costs. They're presented as tiny percentages, easy to overlook. Your fund might grow a bit, giving a false sense that all is on track. But as years pass, the corrosive effect accelerates. Management fees skim the top. Policy charges take their slice. Age-based insurance quietly rises. Even in good market years, your policy value barely moves. That's the fee trap. Rising insurance cost cancels your gains. Try to exit and you hit surrender charges, sometimes for 10 to 15 years. You're left choosing between bleeding money or taking a painful hit now. Now that you understand the problem, let's talk about the solution. It's incredibly simple. The rule: buy term and invest the difference. Separate the 2 jobs and use the best, most efficient tool for each. Term life insurance is pure, simple, and cheap protection. It pays a tax-free lump sum if you pass away during the term, 10, 20, or 30 years. No investment components, no cash value, no complex layers or hidden fees. Maximum peace of mind at the lowest possible cost. Since term is cheaper, you'll have money left every month. That's the difference. Invest it in low-cost, diversified index funds and ETFs with tiny expense ratios and let compounding work. Imagine Sarah and Tom. Each sets aside $500 a month for 30 years. Sarah buys an ILP, $500,000 death benefit plus investments. Hidden fees, management, policy charges, and rising insurance average about 2.5% annually. Tom buys a 30-year term policy with the same $500,000 coverage for about $50 a month, leaving $450 to invest. He invests the difference into a low-cost S&P 500 ETF at about 0.05%. Assume the market earns roughly 8% before fees. Sarah's cash value grows, but only to about $395,000. Tom's account reaches approximately $675,000. That's a staggering $280,000 more for the same $500 a month and same protection. The only difference was strategy. Low fees and transparency win. Hearing these numbers can be shocking. Don't freeze, act. Pull out your ILP policy today and hunt for management fees, policy charges, admin fees, and mortality charges. Demand a benefit illustration projecting future value with current charges, including how insurance costs rise each year. While you wait, get quotes for pure term life from at least 3 reputable companies and compare. Subtract the term premium from your ILP premium. That difference is what you could invest each month. If there's a surrender charge, weigh a one-time penalty against decades of high-fee drag. An independent advisor can help you run the numbers. You were sold convenience, but the price was your future wealth. Keep insurance and investments separate. Buy term, invest the difference. If you like more of this type of content, PL's like and subscribe and share with your friends. Thank you for watching.